Okay, this is Jim McKelvey, and today I'm super happy because Dave Wheelock, who is the Group Vice President and Deputy Director of Research at the St. Louis Fed, is joining me for just a kind of a candid conversation on uh, macroeconomics and monetary policy and money and what's going on with the economy. Dave works for the St. Louis Fed. As you guys probably know, the Fed is this sort of weird beast that has 12 independent regions. I'm deputy chair of the St. Louis region, which is the eighth region. There are 12 of these, and then we all sort of work in coordination with the FOMC, which is a group in Washington, D.C. And one of the things we're really proud of in St. Louis is the quality of our research. We have a bunch of PhD economists who are exceptionally good at figuring out what is happening. And so with that intro, I will ask Dave, what the heck is happening? Like from an economist's perspective, oh my God, this is terrifying. What's going on?
Okay, Jim. Well, it's a real pleasure to be here with you and get the opportunity here to talk about the economy. So my boss, Jim Bullard, who's the president of the St. Louis Fed, has an analogy to what's going on, and I think it's pretty apt. So you're driving down the highway, smooth as silk, 70 miles an hour, and you come upon a construction zone because they got to fix some things. So you got to slow way down and drive, half speed as you're going through this construction zone. But then you get to the end of it, and the signs are clear, and you can zoom back up to 70 miles an hour. So I think it's we're kind of in a slow zone here because we're making an investment in public health, which necessitates turning off parts of the economy, sending some folks home. Unfortunately, some are suffering more than others, but basically that's what's going on. We've hit a construction zone, and we're having to slow way down in order to get things fixed up with regard to the nation's health.
So the economy was basically healthy,
Right.
and we voluntarily decided to shut it down or slow it down to deal with a health crisis. But there wasn't an economic crisis prior to COVID-19.
Right. The economy was in good shape. As recently as January, February, we had record low unemployment, inflation at or slightly below the Fed's 2% target. So, in terms of monetary policy, we were 100% on target basically, and we had good solid growth, and the economy was in good shape. So the virus is what's really slapped us in the face here, and the global pandemic. Nothing wrong with the economy, and for that reason, there's no reason, once we get through this, that we can't get back up to full speed. The question is, how fast is that going to happen, and whether we're going to encounter a few speed bumps along the way. But as you say, we were in good shape coming into this.
Okay, and I didn't get much love at the last Fed meeting for my analogy, which was, if you're in a coma, you could be in a coma where, they wheel you into the hospital and you're basically lights out and nobody knows why. And then there's the kind of coma where your doctor induces a coma for a therapeutic reason.
Right.
And I don't think the coma analogy was too popular with the other directors, but the way I look at it is there is still a question as to whether or not the economy just goes tearing back up to 70 miles an hour or whatever the speed limit it is after this is over. Is there precedent for this? I mean, is there a reason we should believe that once we have dealt with the health crisis, we will not also then be dealing with the effects of being, like will the engine reaccelerate?
Yeah, no, that is the most difficult question to answer definitively, and it's one where there's a great deal of debate. Um, Jim Bullard thinks is quite possible. We could have the so-called V-shaped recovery where the economy comes roaring back the second half of the year. But that's very conditional on the course of the virus and getting it under control and having people confident enough to go back, to restaurants or get on cruise ships and so forth. So it's a big conditional. And I think, a lot of people worry that, the public is going to be a little bit spooked here. There's a shark in the water, and until we're confident that the shark has gone away, we may not be so comfortable jumping back in the pool.
Yeah.
So, it's in terms of precedents, it's hard to think of any. There was a famous flu pandemic in 1918, but it's hard to draw comparisons with that period because that was just at the end of World War I, and so it was confounding factors that were going on then. But I think everything's going to ride here in terms of the course of the pandemic, and that's going to dictate how fast we get out of this, out of the economic soup we're in.
So that sounded to me like a question mark. Like we will hopefully come out of it. Everyone's hoping that, and not to discount Jim Bullard's opinion. Jim is considered an economic badass, and has never been seen in a room at the same time with Batman. So we think pretty highly of him, and the other economists do, but there's really no precedent for this, and even a man like Bullard could get the call wrong.
Yeah, I think there are too many unanswered questions. To take another forecast, Goldman Sachs, which has been one of the most pessimistic in terms of second quarter GDP, for example, big decline in GDP, but they see third quarter coming back very strongly, in part because of all the stimulus that the government is pouring into the economy to try to keep things right. So that's one possibility. If we get a strong fiscal response, we could get strong growth in the second half. But other economists are including some members of the other Reserve Bank presidents, have expressed more, a little bit more conservative about their forecast for the second half of the year.
So if David, we just unpack the math there. We've got an economy that produces roughly $5 trillion per quarter in the United States. Right. And we're expecting something like a 40% reduction in economic output. So that would be about $2 trillion of lost productivity. Is that kind of how you look at it?
That's a rough ballpark, yeah.
I mean, correct my numbers if I'm just sort of.
No, that's about right. So
they only give me numbers with one degree of, like, one significant digit these days. So, I mean, if you want to carry the decimal point out to epsilon, please feel free. But should we? Well, so let me ask you this. I know from my other hats that much of this money is not being efficiently routed to the people who are being displaced right now. I can tell you that both personally from some of the companies that I work with, and also because of the data that I see from some of the other relationships that I have. So let's take as a fact that we are not going to perfectly take $2 trillion and hand it to the people who had $2 trillion of suffering. Right. To a macroeconomist, someone who is concerned about the economy recovering, do we really need to be precise at getting that $2 trillion in? Or if we get it into the hands of, let's say friends of bankers and some scumbags who defraud the government, as well as some good people, is that okay? Or do we really need to be precise with how we water the field?
Well, I think there's a two-edged sword there. I think in a broad sense, you don't have to be that precise. The money gets out into the economy eventually one way or the other. I think in terms of thinking about getting a bridge to the end of the crisis, we want to make sure that the households and the firms that are most directly affected are the ones who get most of the money, basically, because the small business person, the restaurant worker who's lost their job, they're the ones who are really taking the big hit here. And
Yeah.
those of us who are working at home and collecting our usual paycheck, we're not suffering. So, I think from an ethical public policy perspective, I think it makes sense to try to target it to the people and the firms that are most directly impacted by the planned shutdown, to use the words you expressed.
Okay.
But I think, in a macro sense, you're probably right. It doesn't have to match up dollar for dollar, but
Okay. So in other words, if I was worried because I had firsthand or secondhand evidence, and I have, believe me, actually have, well, I don't have firsthand evidence yet, but I certainly have a lot of secondhand evidence that the money is not efficiently going to the people who are being most hurt. And let's take that as a given, that's okay in terms of the economy actually recovering. So as long as the money is there, the equation should eventually balance out, and maybe there'll be some extra Lamborghinis sold. But that would be sort of a small price to pay for the economy recovering. Is that sort of what what a
it's
real economist would think?
I think it's a matter of degree. If too many people are lose their jobs, too many small businesses go out of existence, that just going to slow down the recovery, because
Okay.
it's a lot of capital that's destroyed, job relationships that are destroyed. So that's like throwing sand in the gears, if you will, of the economy. So that would slow down the recovery relative to a perfectly targeted set of programs. But again, matter of degree.
Yeah. So Dave, and I know there are going to be a lot of people listening to this well, it's not even a podcast. It's just a video I'm recording in my study. I don't do a podcast, but whoever's listening to this, can you explain what tools the Fed has? Because we think of the Fed, well, first of all, maybe like start by explaining what monetary policy is, because I don't think people sort of fully grasp that. And actually, just for the record, they don't expect directors of the Fed to grasp that either. Like when I was first invited to join the board, they sat me down, and even though I have a degree in economics, like they re-explained all this stuff, because it is somewhat confusing to lay people or just normal people, what monetary policy versus fiscal policy, what all this stuff is, because it's just like money and who knows. So would you explain kind of what monetary policy is, and then what levers the Fed has to do things when we want to be bailed out? What does the Fed have that can help?
Well, I think the way to think about this is to think about what the Fed has done in this crisis. We've really had kind of a three-pronged approach. And the first was monetary policy. So monetary policy is the purview of the FOMC, the Federal Open Market Committee, which consists of the Board of Governors in Washington, plus the presidents of the 12 reserve banks, the structure you described. So what they did very early in March was reduce their target for the overnight interest rate, the so-called federal funds rate, which is the interest rate that banks, based on loans between banks, at one bank, Bank A to Bank B, makes an overnight loan in the federal funds market. The Fed has a target rate. By reducing that target rate, the Fed is hoping to help bring down rates throughout the economy, everything from rates on Treasury securities to automobile loans to home mortgages and so forth. So it's a stimulative policy action to lower interest rates in general. So the Fed reacted very swiftly. They cut the federal funds rate target to zero. So the interest rate on overnight money is zero. The other thing the Fed did was announce that they're going to keep it at zero as long as this crisis goes on, until we see our employment and price stability goals in sight again.
Okay, so I want to stop you there, and to people who aren't sort of economic historians, what you just said was pretty significant there, which is there are two things the Fed did. One was lower this rate, and I know there's more, but I'm interrupting you because I want to just draw a line.
Yep.
It used to be the policy of the Federal Reserve not to explain what it was going to do, not to say, well, we're going to behave this way in these circumstances. And within the last decade, that policy has actually changed, where the Fed will now commit to doing things and tell you the rules under which it will change monetary policy.
Right.
And that is actually a tool of monetary policy now. It is the signaling. And why is that signaling important before you get to the rest of the rules? Because I think
Sure.
people don't understand how important it is for the Fed to make a promise and keep a promise, and what that does to markets. Could you
Right.
unpack that for a second?
So what you're describing is what economists refer to as forward guidance. So we're trying to send a signal or relay our expectation about where we anticipate the overnight interest rate will be down the road in the future. Because rates are connected in terms of periods of time. So we have the overnight rate, the 1-day rate, the 30-year, or the 30-week rate, all the way out to the 30-year treasury rate. And they're all connected in financial markets. So if we can say, just for example, that we're going to keep the overnight rate at 0 for the next year, for example, then that will tell markets that basically that will affect rates throughout the spectrum. It'll affect the 1-year interest rate, the 2-year rate, the 3-year rate, and so forth. So you can actually, when you're down at 0, as we are now with the overnight rate, you can get a little bit more bang for the buck by promising to stay at 0. And that will tend to hold down longer term interest rates more than if you're just moving the rate around and not saying anything about the future.
Okay.
That's an unwieldy answer there, but
no, it's a great answer, and I want people to understand that one of the things that the Fed does is communicate what it's going to do, and that communication gives markets the ability to sort of calm down. And I think the way this was discovered, and you please correct me if this is inaccurate or misleading, was that the Fed was keeping rates low, and we were expecting the markets to respect that as a signal, and they weren't. So the Fed figured out that if it specifically gave guidance to what it was doing, that the markets, and the markets, of course, trusted the Fed, then the guidance would have the effect that just lowering the rates wouldn't have. And that was actually a very powerful tool and allowed us to, sort of get the markets to behave in ways that we thought was positive.
right. I think, it basically came out of the financial crisis 10 years ago.
Yep.
When another period, we got interest rates down to 0 at the overnight rate. And by sort of explaining that we're going to keep it low until the economy starts to recover and employment comes up and so forth, that gets you a little more bang for the buck in terms of helping bring down longer term interest rates in the economy. Everything from 10-year treasuries to mortgage rates and so forth. So it gives you a little more extra stimulus than if you didn't give that signal. Yeah. I would add that it's not a promise. I don't want to emphasize. I want to emphasize this too much. It's not a promise. It's more of our expectation. It's what we refer to as a data-driven policy. It depends on how the data come in and as to how fast rates will go back up or whatever. So it's not a promise, but it's our best judgment as to where rates will be headed. And to the extent you could say, we're going to keep them here until we start seeing a recovery of employment and prices going back up. I think that has some credibility that is going to be effective.
Yeah. So and I do want to get the rest of your answer, but I'm just going to translate that into business speak, because as somebody who is a business person and I have to borrow money, I don't borrow money overnight, like a bank does. I borrow money for a period of time, a year, 2 years, 5 years, 10 years, to build something or start a business. And one of the things that lowering the interest rate is supposed to do is it's supposed to lower my costs as a business person of borrowing that money. And when it doesn't happen, because the banks don't trust, or the financial world doesn't trust that these low interest rates are going to continue, then it doesn't actually affect me as a business borrowing money and starting a new thing. So by giving this guidance, the Fed has figured out a new economic tool. And this is a big deal because we've had monetary policy for like a century, and we have just recently discovered that this forward guidance is powerful. And so we're doing that, and the market seems to be respecting it. Okay, so now continue with all the other stuff that the Fed
Okay.
is able to do. But it's an important point
Yeah.
because I don't think people understand that.
Sure. So one of the objectives of forward guidance was to help bring down long-term interest rates. But the other thing the Fed announced it was going to do and has been doing since March are the quantitative easing measures, large asset purchases of treasuries and mortgage-backed securities, which will also help bring down longer-term interest rates, but also provide more functioning to the Treasury and other financial markets. So that's the monetary policy side of the house.
So can I ask a question here that people don't understand? Where does the money come from to do that? Like when you buy $1 trillion worth of treasuries, where do you get the $1 trillion?
Yep. So the magic of banking is we make a loan or make an investment, and that adds to our asset portfolio. But in order to pay for it, we create a liability. We borrow money from the banking system basically by pouring reserve deposits into the accounts that banks and other depository institutions have at the Fed. So it is in some sense creating money out of thin air.
Is there a limit to how much of that you can do?
In principle, no. The Fed has a balance sheet like everyone else. We have liabilities and capital on one side and assets on another. But by law, we have no limit in terms of a reserve requirement or a capital requirement. So in principle, we could buy assets subject to the constraints of the law, which limits the type of assets we can purchase. But then in so doing, we create reserve deposits for the banking system.
Okay, so this is mathematically sound, but hard for an individual to understand. Like if you're thinking about this as borrowing like an individual, borrowing for a company, borrowing for a country that has a central bank, especially a central bank that is the world's reserve currency, is not like me running up a bunch of credit card debt.
That's right. We can get away with it.
Okay.
That, and in part because we are, the U.S. has a long history of paying its bills and being credible, and we can borrow that money basically, but it's basically just banking. So when a commercial bank makes a loan to a customer, it adds money to that customer's checking deposit, which the customer then goes out and spends. So it's in practice really pretty much the same. But a commercial bank, of course, is constrained by requirements of maintaining a particular level of capital relative to its assets and so forth. And the Fed doesn't legally have that kind of a constraint.
Okay. So anything else that the Fed is able to do
So I summarized what we did in response in terms of monetary policy, but this was really not a garden variety recession by any means, and therefore it's not one that's just amenable to a monetary policy fix. And so the Fed has taken a number of other steps to keep the plumbing of the financial system going. And in some sense, those are arguably even more important steps. So, for example, right off the bat, the Fed lowered its discount rate, which is the interest rate that it charges banks when they come to the Fed to borrow money. We cut that down to almost zero. It's now 25 basis points or a quarter of a point. We also allow them to borrow up to 90 days. Other actions the Fed took, we reduced the reserve requirements that banks, that's now down to zero.
Okay, so you cut out there.
We also encourage banks
auto-tuning for a second. So I'll just repeat. You've taken the reserve requirements down.
Right.
Which means banks don't have to keep as much cash against loans.
That's right. It gives them a little more space to make loans to the households and firms.
Okay.
And by the same token, we've encouraged them to use their capital and liquidity buffers that they had.
Are they actually doing that? Because sometimes I know banks, when you tell them to do one thing, they do something else. So should we trust the banks?
It's a little early yet in terms of we haven't got the data in terms of lending,
Okay.
and so that leads me to my next point, which is the third prong of the policy response by the Fed has been the creation of this alphabet soup of new programs in conjunction with the Treasury Department to address um, instability or broken markets, everything from the commercial paper market to corporate bonds to municipal bonds, and coming down the road, facilities to help finance loans to small and medium-sized businesses. So those programs have been announced, just barely beginning to get going. So you can't just announce them and start lending that day. There are legal protocols and so forth and things that have to be set up, but they're in train. So some of the programs have been up and running now for a few days. Others are coming down the road. So these are programs that are allowed by law in unusual and highly unusual circumstances with the approval of the Department of the US Treasury. You can set up these programs to provide lending facilities to finance particular market segments of the economy that need additional funding.
Okay. So Fed working with Treasury, working with, I guess, the government to pass laws and allow you to legally do all this stuff, is not only trying to keep the banking system working and trying to keep businesses in business, but it's also trying to provide effectively help to make sure that various other markets, credit markets, debt markets, bond markets, are still functioning. And again, I'm like, to an individual, like, why would I care that a bond market works? Like, I don't own any bonds. I don't even know what a bond is. Uh, you know, uh, so why do I care?
If the Treasury market's broken, the federal government can't borrow the money it needs to finance the programs that it's putting out, for example. If corporations can't continue to borrow money, they need the money to keep their operations flowing during the crisis. So it's just as important that all of these markets be functional, and that the liquidity is happening is there for all of the markets to be functioning. So the Fed has gone in to specific markets and set up facilities to provide the liquidity so that they, again, this kind of a bridge financing idea to get them through the crisis.
Is it working?
Well, again, it's early, but we've seen some signs. So the volatility in the U.S. Treasury market is about back to normal levels, for example. When the Fed announced new facilities to provide liquidity to the corporate bond market, the spreads between corporate bond interest rates that had shot through the roof relative to treasuries, they started to come back down. So even though the market's not yet up and running, just the announcement that it's coming had a salutary effect on financial markets, helped calm things down. So we're hoping we'll see more of that happening as these programs get rolled out.
So the fact that the markets feel like the Fed is watching this makes them calm down.
Yeah, it's the expectation that the money is going to be there.
Okay.
Has reduced volatility in the markets.
So it's not working.
It's improving. Let's put it
Okay.
that way. The markets are improving on the announcement of these various facilities, and as they get rolled out, I think we'll see how much uptake there is. But they're there to provide the backstop to get us through this on the financial side.
So, Dave, I mean, we went through a financial crisis in 2008, 2009, and the Fed sort of created quantitative easing in that crisis and developed a lot of these new tools in the ensuing decade or 12 years. What percentage of the current crisis is familiar? Is it 50%? Are we sort of, oh, we've been here, we know how to do this, or is it like 20%? Like what? how familiar is this particular crisis?
Yeah, I would say having been here in 2008 and involved, I would say it's pretty different. You know, the origins of this crisis are very, very different. The economy coming into the crisis was in much better shape this time, fortunately, than it was in 2007 and 2008. We didn't have the imbalances of all the subprime debt overhang and all that. That was a real classic financial crisis. But this is a financial freeze up caused by the health crisis, basically. And so the players are different. We don't have the problems in the mortgage market today that we did 10, 12 years ago, for example. We don't have the vast amount of short-term debt funding, crazy paper, that was based on subprime mortgages uh, that we had at that time. So it's different. The banks are in much better shape, much better capitalized now than they were going into that crisis.
So that sounds like it's better. Like this is a better crisis than that. And from where I sit,
Yeah,
I'm like more worried. But
it's different.
different.
I think this time it's the economy is much quicker decline in economic activity. Um, it has the potential to spill over to be in a financial crisis if we don't respond quickly. The Fed has responded much, much more quickly in this crisis because it came upon us so much more quickly.
Now let's talk
So
about the Fed responding quickly. The Fed is, in this case, the FOMC in DC, not the 12 reserve banks. So the 12 reserve banks, what is your role as in one of the reserve banks? What?
right. So the Reserve Bank presidents are participants in the Federal Open Market Committee, the FOMC. So
Okay.
they have a direct role in monetary policy. The other activities that we're talking about, like the activities for changing bank regulations, all these additional programs that were created, that's under the purview of the Board of Governors in Washington. So we can provide some advice and input and comments, but Jim Bullard, our president, is not directly voting on the creation of any of these programs, for example. So that's under the purview of the U.S. Treasury Department in conjunction with the Board of Governors of the Federal Reserve System.
Okay. Um, so switch to sort of a general question. If all of this new money is being created through accounting, isn't this going to trigger massive inflation?
Well, that's a good question. It's probably a second order concern right now. We're in a position where we don't have an inflation problem. We did not have an inflation problem coming into this event. In fact, inflation had been running somewhat below the Fed's target. So, we have, in some sense, a happy circumstance that we don't have a high inflation coming into this. And I think the other lesson we've learned from the financial crisis of 2008, 2009 is that the Fed can put a lot of money out into the economy and it need not create massive inflation. That one did not for various reasons, but we eventually, I think partly because the money was expected to come back in and the Fed did begin over time to reduce its balance sheet and to normalize the level of interest rates. I have no reason to doubt that that's going to happen again this time. Once we get through the crisis, we can start reining in the size of the balance sheet, pulling back some of that massive stimulus and money that's been injected into the economy, scale back those programs, and in so doing, prevent inflation taking off. So I'm not worried about the Fed's causing inflation and with all this injection right now.
Okay. And by the way, just for people who don't have economic history as a background, a lot of people were highly critical of the Fed in handling the 2008 financial crisis because they were printing money. They were doing all this stuff, quantitative easing. And I heard a bunch of people, sort of shouting at the camera saying that this was going to destroy the U.S. economy and cause all sorts of massive inflation. Well, it turns out that didn't happen. As a matter of fact, it didn't even cause enough inflation to hit this, sort of paltry 2% target that the Fed had set. So now you can't necessarily say it's going to happen exactly the same way this time, because new set of circumstances, as Dave has told us. But in fact, a lot of these people who scream at the TV that we're printing money and going to wreck the economy and we should go back to the gold standard or something like that, were wrong in the past and may, in fact, not be correct in this case as well.
Yeah, that's right. And for various reasons. The Fed has new tools that it didn't have before 2008. It pays interest on the reserve deposits that banks have at the Fed. That helps prevent an explosion of lending that might be inflationary. And then I think the expectation that once the crisis is passed, we're going to rein this back in. The Fed has established credibility over the last 30 years of keeping inflation under control. And so that expectation gives us the latitude, if you will, the freedom to inject a lot of money in the economy quickly to help bridge us through this crisis.
Okay, so now I'm going to ask a real economist question, because I don't have a PhD in economics, but I believe you do. So at least everybody in the Fed seems to have a PhD, at least in the research department. So I think there is a special circumstance created because in times of crisis, the U.S. is not only part of the crisis, but we're also the reserve currency for the world, which means that when people panic in Panama, they want to buy dollars. When they panic in Singapore, they want to buy dollars, not yen, not any other currency. They tend to run to the dollar. And because of that, it causes some very weird math. Dave, what's your feeling, given that we do have a worldwide crisis? This is not a U.S. economic crisis. This is a worldwide economic/health crisis. How does having the world's reserve currency change what we can do, and how does it affect the outcome for the U.S. and the world?
Well, you're absolutely right that there's a run into the U.S. dollar. There's a shortage of dollars around the world. In fact, the Fed has taken a few actions to try to provide some dollar funding to the rest of the world to help those financial markets going, because we are all interconnected.
So this is super interesting. We're creating some of the money that the U.S. creates never gets spent in the U.S. It just goes out of the U.S. for other companies, other countries to spend. Is that how we should think about it?
So, for example, we have what's so-called swap lines with some other central banks around the world, and so we entered in these agreements where we will give them some dollars in exchange for their currency at a fixed price, and then they can lend those dollars out to financial market participants in their own countries. When those dollars are repaid, we get the money back. There's no risk to the U.S. of losing money on those. It's a way of getting dollar funding out, because the dollar is used so widely around the world in all sorts of financial transactions. And so we have that privilege. It gives us the ability, frankly, to borrow more than we could otherwise. Not only the Fed to create money, but it gives the federal government the ability to borrow a lot of money at a lower interest rate than they could if the dollar wasn't this bastion of strength and so highly demanded around the rest of the world.
So in other words, because there's so much demand for dollars, we're able to print them without causing as much inflation as you would normally expect.
Right. And again, it enables the Treasury to borrow more at a lower interest rate than they could otherwise.
Okay. Very good. So how long? Well, I'll just ask the question another way. Are you stockpiling toilet paper?
I wish I had some. My boss told me today he managed to get to the senior hour at Costco and was able to get 24 rolls. So
There you go. There you go. Well, that must be Chris, right?
yes.
I got his cell phone. I'll give him a ring. Um, uh, no, is there any reasonable projection as to how long we would expect to be in this, or is that up to the doctors, not the economists?
It's up to the doctors and it's up to the virus, I think. It's an investment in public health that we're shutting down parts of the economy in order to so-called squash the curve, or you know uh, get the pandemic under control. And the pandemic and the broader medical response will kind of dictate how quickly the economy can recover.
Is there a point at which the economy has been in a coma, or I'm sorry, I'll use Chairman Bullard's analogy, driving slowly? Uh, is there a point of time beyond which you would become concerned?
Well, I'm already concerned about the cost to the individuals who've lost their jobs and to the firms that are on the ropes because don't have any revenue.
Yeah.
It is very concerning, and then people have difficulty paying their mortgage or whatever. So it
Yeah.
is a problem. But and I'm not in a position to say that it's whether it's worth it in terms of the public health. That's beyond my pay grade to make those kind of decisions. But there is a discussion about reopening the economy and how do you do that. And Jim Bullard has talked about more widespread testing and frequent testing. This is being very important to getting people comfortable with going to work or going back to restaurants, whatever. That sort of normal activity, the steps that will have to be taken in order to achieve a normal activity. There are also some interesting lessons from the last big pandemic, which was just over 100 years ago, the Spanish flu pandemic of 1918 and 19. And some research finds that cities that responded more quickly and held in place kind of their social distancing measures not only had lower mortality rates from the flu, but they ended up having better economic performance down the road. Not clear why that necessarily was the case, but it suggests there's not necessarily a pure trade-off between the shutdown measures versus the public health measures. They may be more complementary than pure offsetting trade-offs. A lot of differences between that epidemic and now, but it is at least gives some hope that it's not all cost and no benefit down the road.
Well, that's encouraging to sort of end with, which is to say that this is not the first time an economy or a U.S. economy has faced a pandemic. It is certainly a new one. We have more tools, we have newer tools, and we're using one of them right now. We're carrying on a conversation using a tool that wasn't around 5 years ago.
Right.
So there is that, and history also tells us that there may be some reason to be to think that the better we control the health crisis, the better we will have an economic recovery once we start to need one.
I think that's right.
Dave, I really appreciate this. This is super helpful. Anything else you want to say? I mean, I know you gave an entire presentation at the Fed about this, and I've just been asking sort of random questions, but any other sort of high points that you think people should know?
No, I think we've covered it pretty well. I'm very happy to have done this.
Very generous of your time to give us this, and hopefully this will answer some questions for people, because I know a lot of people have them, and I think your answers were clear and very helpful. So, Dave, thanks again, and
Okay.
I hope to be able to shake your hand at some point in the future.
That's right. Very good, Jim. Thank you very much. Stay well.